So my 2017 outlook is titled America First. And I chose that title obviously because it brings to bear a lot of the questions around the Trump administration and what the world is going to look like over the next several years. To me, America First can mean any number of things. It can mean America is the best place to invest. It can mean America is the place we really need to understand first before we can think about the rest of the world. Or it can mean, in kind of the Trumpian sense, that America, we are going to put America first. Now, how I tend to analyze these situations in this process is through what I call the global risk nexus, which is really the interplay between economics, politics, policy, and markets. And here, when you think of economics, we can discuss the move from deflation to inflation, or the potential for that move. We can focus on the political side between things like Brexit and Trump and the European elections that are coming in 2017. And in the policy side, we can think about the move from pure monetary policy to a joint fiscal monetary policy approach. And of course, in the market segment, it's really how do we put all these things together and invest in a way that provides an attractive risk reward for the various different types of investors. So as I think about the world, really, I think it's important to start off with President Trump and what he is all about. And I think there are a couple of things to keep in mind. First of all, his history suggests that he's a borrower, he's a builder, he's a negotiator, and he's a tweeter. And we've certainly seen the tweeting effect since he has taken office, and of course during the campaign as well. And so I think as we consider President Trump and his policy mix, I think it's important to think about the potential to kind of follow a narrow path, a narrow policy path between what I call full-bore Trump, or a Trump that is very aggressive on fiscal policy with large tax cuts, a very large debt-funded infrastructure program, and a Buy American component to that, all of which can lead to potential overheating, and even if not overheating, lead to what I would call the rise and return of bond vigilantes, which I think would be quite problematic for the economy if interest rates were to shoot up suddenly, as well as obviously problematic for financial assets, be they stocks or bonds. The other side of the narrow policy path for a Trump administration is what I call unmoored Trump, or a Trump administration that is not able to fully coalesce around a set of policies that provide success in terms of jump-starting economic activity. And here I think the first 100 days are going to be very important to get a sense of which one of these Trump policy paths we are going to follow. But there's clearly a sense that President Trump is going to govern as he campaigned. He's going to govern in a very aggressive pro-American approach on trade, which we've already seen in regards to his deciding to withdraw the U.S. from the TPP, as well as some of the back and forth in regards to Mexico and NAFTA, in the renegotiation of NAFTA. It's important to recognize that I believe we continue to be in a low growth, low inflation, low rate world with some important caveats, namely that the direction of growth is up, particularly in the developed economies. I think that's important to note. But the degree is slight. In other words, the global economy, and in particular the developed economy growth profile, is better today than it was probably 6 months ago. There's a decent tone of growth in the United States. Europe seems to be actually recovering more quickly. Brexit didn't derail the UK economy, or at least not yet. Japan seems to be growing reasonably well. So we do have an environment where growth is slightly better than expected, and inflation is likely to be slightly higher than expected. But by the same token, it's also hard to see a surge in any of these indicators, whether it be growth or inflation or interest rates. So in that sense, we're still in a low growth, low rate world, which means that we have a tricky transition to go from pure monetary policy, which is what has sustained the world economy for the past 7 or 8 years since the great financial crisis, to move from a pure monetary policy focus to what I call a fiscal monetary joint venture. And here the opportunity is to bring into play fiscal policy, particularly in the United States, but also in Europe and in Japan, to bring fiscal policy into play to support monetary policy as central banks then hopefully can start to step away from their kind of outsized role that they've employed over the last several years. How that process works, how that tricky transition works, I think is going to have a big impact on how 2017 unfolds. So far we've covered the first three, economics, politics, and policy. Now how do we bring that to bear in thinking about the markets? From a very big picture perspective, our outlook for 2017 is to favor equity over debt, to favor non-US equity over US equity, to favor developed markets over emerging markets, and to favor small and mid caps over large caps. On a sectoral basis, our favorite sector is financials, mainly because financials protect against the risk of sharply higher interest rates, and also they protect against currency shifts where, since each major bank, or the major banks in each country, particularly in let's call it Europe, Japan, and the United States, are more focused on their domestic market. So currency fluctuation has less to do with it than other sectors, for example. Within fixed income, we favor credit over duration. We prefer high yield over investment grade. The search for yield remains intact. And we prefer dollar emerging market debt versus non-dollar or local currency emerging market debt. Within the foreign exchange space, we prefer the dollar, though we are not big believers in significant dollar move. But given the world we live in, the fact that the Fed is likely to raise rates at least once or twice, I'm not sure about 3 times, but at least once or twice, and Bank of Japan and the ECB are limited in their expectation of raising rates, I think it's wise to suggest that the dollar is probably going to be, at the margin, the stronger currency. I do think that the idea that the euro is going to parity is a mistake. People need to recall that Europe has a very massive current account surplus, and whenever the financial players are not involved, the traditional trade flows and merchandise flows are very euro supportive. So I'm not a believer that the euro-dollar rate is going to go to parity. I expect it to be somewhere around the 105, 110 range over the course of the year. In commodities, I don't have a strong view. I do think a gold position makes sense to protect against uncertainty, whether it be political or economic or policy. Not a big believer in a sharply higher oil price. I think there's a great desire to pump oil irregardless of the OPEC deal. And I also believe that the U.S. Shale revolution is going to come back into full bore. And I noted that just the other day, the rig count for the U.S. came out, and it's now up about 80% from the low of just a year or so ago. So oil, I think, at current levels probably has limited upside and could face some fairly meaningful downside if this rig count in the U.S. continues, and if there's any cheating in the OPEC supply reduction agreement.